Stop what you're doing right now. If you have money in the stock market, if you have savings in a bank, if you own a home with a mortgage, I need you to lock in for the next 25 minutes because what I'm about to show you is going to fundamentally change how you think about the stability of the global financial system. And I'm not being dramatic here. I'm talking about something that most people, most financial advisors, most mainstream analysts are completely missing right now. We are sitting on top of a $15 trillion stress test that makes 2008 look manageable by comparison, and the cracks are already starting to show. Something shifted in the last 6 months that changed everything about the risk profile of global markets, and the data I'm seeing from central banks, from bond markets, from the banking sector is making my hands shake as I record this. We're watching stress accumulate across multiple systems simultaneously in a way that hasn't happened in modern financial history. In 2008, we had a housing crisis that became a banking crisis that became a credit crisis. It was terrible. It was destructive. Millions of people lost their homes and their jobs, but it was essentially one domino chain. What we're facing now is different. We have sovereign debt stress, banking sector fragility, commercial real estate collapse, pension fund insolvency, and currency instability all happening at the same time in an environment where central banks have already used all their traditional tools. The ammunition that saved us in 2008 is gone, and the problems we're facing now are bigger. Here's what we're going to cover today, and I need you to stay with me through all of this because each piece builds into a picture that should terrify anyone with assets in the traditional financial system. First, I'm going to walk you through exactly what this $15 trillion stress test is. Not the vague headline number, but what it actually represents in terms of debt that's rolling over, banks that are underwater on their bond holdings, commercial real estate that's worth 50% less than the mortgages against it, and pension funds that are mathematically insolvent. We're going to look at the specific institutions and markets that are under stress right now and why they matter to you personally. Second, I'm going to show you why this is actually worse than 2008 by comparing the two crises side by side. In 2008, we had options. Central banks could cut rates to zero, they could do quantitative easing, governments could bail out banks. What can they do now when rates are already elevated and inflation is persistent and government debt is at levels that make bailouts politically and mathematically impossible? And third, I'm going to give you my framework for what to do about this. How to position yourself, how to protect your wealth, how to think about risk in an environment where the traditional safe havens might not be safe, and the institutions you've trusted your whole life might not be trustworthy. Now here's why you need to hear all of this. The mainstream financial media is not connecting these dots. They'll report on regional bank stress as a separate story from commercial real estate problems, as a separate story from European debt concerns as a separate story. But they're not showing you how these pieces fit together into a system-wide fragility that could unravel very quickly once a trigger event occurs. They're not explaining why the tools that worked in 2008 won't work this time, and they're definitely not giving you actionable steps to protect yourself. But before I get to that, you need to understand what happened in 2008 and why everyone who lived through it thinks they know what a financial crisis looks like, because that mental model is going to be wrong this time. And if you're preparing for a 2008-style crisis, you're preparing for the wrong thing. Let me take you back to September 2008. Lehman Brothers collapses. It's the largest bankruptcy in U.S. history at the time, $600 billion in assets, and it triggers a complete freeze in the credit markets. Banks stop lending to each other because nobody knows who's holding toxic mortgage-backed securities and who's about to go under next. The commercial paper market, which is how corporations fund day-to-day operations, seizes up. Money market funds break the buck, meaning a dollar invested is worth less than a dollar, and investors panic. The stock market crashes, losing over 50% from peak to trough. Housing prices collapse, foreclosures surge, unemployment spikes to 10%. It's a disaster. But here's what's important to understand about how we got out of it. The Federal Reserve cut interest rates from over 5% down to zero in a matter of months. That's 500 basis points of ammunition. They implemented quantitative easing, buying trillions of dollars of government bonds and mortgage-backed securities to inject liquidity into the system. The government passed TARP, the Troubled Asset Relief Program, $700 billion to bail out banks. They effectively nationalized AIG, Fannie Mae, Freddie Mac. They forced bank mergers like JP Morgan buying Bear Stearns and Bank of America buying Merrill Lynch to prevent total collapse. And it worked, sort of. The financial system stabilized, the stock market recovered, housing eventually bottomed and came back, unemployment came down. But here's what that rescue cost. The Federal Reserve's balance sheet went from under $1 trillion to over $4 trillion. Government debt exploded from about $10 trillion to over $20 trillion in the decade following the crisis. Interest rates stayed at zero for 7 years. creating massive distortions in asset prices and encouraging risk-taking and leverage throughout the system. We didn't actually fix the underlying problems. We papered over them with printed money and zero rates, and now those chickens are coming home to roost. The $15 trillion stress test I'm going to show you is the direct consequence of the choices made in 2008 and the decade of ultra-loose monetary policy that followed. Now fast forward to today and let me show you exactly what I'm seeing in the data, and I'm going to give you specific numbers because vague warnings don't help anybody. Let's start with the banking sector. In 2008, the crisis was concentrated in the largest banks that had made stupid bets on subprime mortgages. This time, the stress is more distributed, and it's sitting in plain sight on bank balance sheets in the form of unrealized losses on bond holdings. Here's how this works. When interest rates were at zero, banks bought long-term government bonds and mortgage-backed securities, paying 1 or 2% yields. Those were safe assets, government guaranteed, and they provided some income. But when the Fed raised rates from 0 to over 5% in 18 months, the fastest hiking cycle in 40 years, the value of those existing low-yield bonds crashed. A bond paying 2% is worth much less when new bonds are paying 5%. Banks are still holding those bonds at face value on their balance sheets as held-to-maturity securities, meaning they don't have to mark them to market. But the reality is they're sitting on massive unrealized losses. The FDIC estimated that U.S. banks are sitting on over $600 billion in unrealized losses on their securities holdings. $600 billion. That's larger than the entire market cap of most banks. Now, as long as depositors don't panic and withdraw their money, banks can hold these bonds to maturity and eventually get paid back at face value. But if there's a run, if depositors demand their money, banks have to sell these bonds at a loss to raise cash, and that crystallizes the loss and can render the bank insolvent. We saw this exact scenario play out with Silicon Valley Bank in March 2023. SVB had unrealized losses on their bond portfolio. Depositors panicked and withdrew over $40 billion in a single day. The bank had to sell bonds at a loss, and they failed. The FDIC took them over. Then Signature Bank failed. Then First Republic failed and got absorbed by JP Morgan. 3 major bank failures in a matter of weeks, and the contagion only stopped because the Fed and FDIC stepped in with emergency liquidity facilities and backstopped uninsured deposits. But here's the thing. The problem didn't go away. The $600 billion in unrealized losses is still sitting there. Regional and community banks are still underwater on their bond holdings, and they face another problem that SVB didn't have to the same degree: commercial real estate exposure. Small and mid-sized banks are heavily exposed to commercial real estate loans, office buildings, retail space, hotels, and the commercial real estate market is in free fall. Office buildings are worth 30 to 50% less than they were 3 years ago because remote work has permanently reduced demand for office space. Occupancy rates in major cities are running at 60 to 70% of pre-COVID levels. Companies are downsizing their footprint, breaking leases, and landlords can't make the debt payments on buildings that are half empty. Mortgages that were written when buildings were fully occupied and valued at peak prices are now underwater. The building is worth $50 million, but there's a $75 million mortgage against it. What happens when that mortgage comes due and needs to be refinanced? The bank either has to extend and pretend, rolling over a bad loan and hoping things improve, or they have to force a sale and take a massive loss. The total commercial real estate debt in the United States is over $5 trillion. A significant portion of that, probably $2 trillion or more, is at regional and community banks. And over the next 3 years, roughly $1.5 trillion of commercial real estate debt is maturing and needs to be refinanced. Refinanced at what rates? When the loan was originated, rates might have been 3%. Now they're 7%. The debt service just more than doubled. Can the property cash flow support that? In most cases, no. So you have a wave of distressed commercial real estate coming, and the banks holding those loans are the same banks that are already underwater on their bond portfolios. This is a toxic combination, and it's sitting there waiting for a trigger. Now let's cross the Atlantic and look at Europe, because the stress there is even worse in some ways. European banks are sitting on over 1 trillion euros in unrealized losses on bond holdings. Similar problem to US banks, but with less regulatory cushion. But the bigger issue in Europe is sovereign debt. Italy has a debt to GDP ratio over 140%. Their debt is almost 2.9 trillion euros. France is at 112% debt to GDP. Spain, Portugal, Greece, all running debt levels that would have been considered crisis territory a decade ago. And the mechanism that was holding this together, the European Central Bank buying government bonds to keep yields suppressed, that's over. The ECB had to raise rates to fight inflation just like the Fed did, and now they're in the awkward position of trying to tighten monetary policy while member states are drowning in debt. We got a preview of this problem in the UK in 2022 when Liz Truss proposed unfunded tax cuts and the bond market revolted. Gilt yields spiked, pension funds that were leveraged to UK government bonds faced margin calls, and the whole thing nearly collapsed until the Bank of England stepped in with emergency bond buying and Truss resigned. That was a warning shot. It showed how fragile the sovereign debt markets are and how quickly things can spiral when bond vigilantes lose confidence. Now imagine that happening in Italy or France, countries with much larger economies and much larger debt burdens. If Italian bond yields spike because investors lose confidence in Italy's ability to service their debt, the ECB would have to choose between letting Italy default, which would destroy the euro, or printing money to buy Italian bonds, which would destroy the credibility of the ECB and potentially trigger inflation. There's no good option. And this brings us to Japan, which is the most extreme example of the sovereign debt trap. Japan's debt to GDP ratio is over 260%. Their government debt is over $10 trillion. For decades, they've been able to carry this debt because interest rates were zero or negative, so the debt service cost was manageable. But now, the Bank of Japan is facing inflation for the first time in 30 years, and they're being forced to let rates rise. They've been defending a cap on 10-year government bond yields, basically doing yield curve control, but that's becoming untenable as global rates rise. If Japan loses control of their bond market, if yields spike to even 2 or 3%, the debt service cost becomes a huge portion of their government budget, and they're forced to either default, print money at a pace that destroys the yen, or implement austerity that crashes their economy. Any of those outcomes would send shockwaves through global markets, because Japanese institutions own trillions in global assets, and a crisis there would force selling across all markets. Let me add up the stress for you. $600 billion in unrealized losses at US banks, $2 trillion in at-risk commercial real estate loans, €1 trillion in unrealized losses at European banks, trillions in questionable sovereign debt in Europe, $10 trillion in Japanese government debt at risk if rates rise, and I haven't even mentioned China's property sector collapse, which is probably another few trillion in bad debt, or the hundreds of billions in losses sitting in pension funds globally that are underfunded and can't meet their return assumptions in this environment. When I say $15 trillion stress test, I'm being conservative. The actual amount of at-risk debt and underwater positions in the global financial system is probably closer to 20 or 25 trillion when you add it all up. And it's all interconnected. A crisis in one area triggers selling in another, margin calls lead to forced liquidations, and you get a cascade. Now here's why this is worse than 2008. And I need you to really understand this distinction because it's critical to how you think about protecting yourself. In 2008, the problem was a crisis of solvency in the banking sector caused by bad mortgage bets. The solution was to recapitalize the banks with government money, cut interest rates to zero to reduce debt service costs, and do quantitative easing to inject liquidity. It worked because central banks had the ammunition to do it. Rates were over 5%, so cutting to zero was powerful stimulus. Government debt was manageable, so adding a few trillion to bail out banks was politically difficult but mathematically feasible. And inflation was not a concern because the economy was in deflationary collapse, so printing money was appropriate. None of those conditions exist today. Interest rates are around 5%, but inflation is still running well above the Fed's 2% target. If the Fed cuts rates aggressively to save the banking system or the commercial real estate market, they risk reigniting inflation. Remember, inflation is still elevated despite all the rate hikes. Core inflation is running over 3%, housing costs are sticky, wage growth is still strong. If the Fed goes back to zero rates and QE in this environment, inflation could easily spike to 8, 10, 12%, and that destroys the currency and the bond market. So the Fed is trapped. They can't use their 2008 playbook without triggering an inflation crisis. Government debt is now over $34 trillion, 125% of GDP. In 2008, it was 70% of GDP. The government doesn't have the fiscal space to do another massive bailout like TARP without triggering a bond market crisis. If the government tries to borrow another $1 trillion to bail out banks or backstop commercial real estate losses, bond yields would spike because investors would question the sustainability of U.S. debt. Higher yields make the debt spiral worse, which makes the crisis worse. So the government is trapped too. And unlike 2008, when there was political will to do whatever it took to save the system, the political environment now is toxic. The public is not going to tolerate another billionaire bailout. Politicians know that proposing to use taxpayer money to save banks is political suicide. So the political will to act decisively might not be there until it's too late. The other massive difference is the global nature of the stress. In 2008, this was primarily a US and European problem. Emerging markets were relatively insulated. China was growing at 10% and actually helped pull the global economy out of recession with massive stimulus. Now China is the problem. Their property sector, which is 30% of their economy, is in collapse. Evergrande defaulted, Country Garden defaulted, dozens of smaller developers are insolvent. Chinese local governments are buried in debt from infrastructure projects that don't generate revenue. Chinese banks are sitting on trillions in bad loans, and the Chinese government doesn't have the same ability to stimulate like they did in 2008 because their debt levels are already elevated. So instead of China being a source of global growth and stability, they're a source of deflation and instability. Let me walk you through what a crisis scenario looks like given all of these stresses, because I want you to understand the sequence so you can see it coming if it starts. It doesn't take much to light this fuse. The trigger could be another regional bank failure in the US that's bigger than SVB and creates deposit flight across the banking sector. It could be a major commercial real estate default, like a large REIT or property owner declaring bankruptcy and triggering a repricing of the entire sector. It could be a sovereign debt crisis in Europe, Italy, or France, seeing bond yields spike and facing a funding crisis. It could be Japan losing control of their bond market and the yen collapsing. It could be a major pension fund in the UK or Europe facing insolvency and needing a government bailout. Any of these could be the match that lights the fire. Once the trigger occurs, here's the cascade. Investors panic and sell risk assets. Stocks drop, corporate bonds sell off, credit spreads widen. Institutions that are leveraged face margin calls. They have to sell assets to meet those calls, which drives prices lower, which triggers more margin calls. It's a self-reinforcing loop. As asset prices fall, more of those unrealized losses on bank balance sheets become realized. Banks have to raise capital. They cut lending to preserve their balance sheets. Credit dries up. Companies that were relying on cheap credit to roll over debt face refinancing problems. Defaults increase. The high-yield bond market, which is over $1 trillion, faces a wave of downgrades and defaults. Pension funds that are required to sell downgraded bonds face forced selling into a falling market. Governments try to respond, but they're constrained. The Fed might cut rates 50 or 75 basis points, but they can't go back to zero without triggering inflation fears. They might restart QE, but the bond market might rebel because inflation is still a concern. The government might try to pass an emergency spending bill, but it gets bogged down in political fighting, and by the time something passes, it's too little too late. Meanwhile, the crisis is spreading globally. European banks that have exposure to U.S. commercial real estate or U.S. bank bonds start facing losses. The ECB has to choose between supporting European banks and maintaining price stability. Japan faces a run on the yen as investors lose confidence. Emerging markets see capital flight as global investors pull money back to perceived safety. Within weeks, you could see a full-blown global financial crisis that makes 2008 look tame. Stock markets down 30, 40, 50%. Bond markets in chaos with some yields spiking and some crashing as investors flee to the safest remaining assets. Banks failing or being bailed out, credit markets frozen. And the terrifying part is, I'm not sure the tools exist to stop it this time. In 2008, overwhelming force from central banks and governments stopped the cascade. This time, that overwhelming force might not be available or might not work because the underlying conditions are different. So what do you do? How do you position yourself when you're facing a potential crisis of this magnitude and the traditional playbook doesn't work? Let me give you the framework I'm using, and then I'll give you specific tactical steps. The first principle is that you need to think in terms of multiple scenarios, not a single predicted outcome. I can't tell you with certainty that this crisis happens in the next 6 months or 2 years, or that it doesn't happen at all. What I can tell you is that the risk is elevated, the fragility is real, and you need to position for a range of outcomes. That means not going all in on any single bet. You're not selling everything and going to cash. You're not leveraging up to buy gold. You're building a resilient portfolio that can weather different scenarios. Second principle is that cash and liquidity are more important now than they've been in years. In a low-rate environment with stable markets, holding cash is a losing proposition because inflation eats your purchasing power and you miss out on investment returns. But in a crisis, cash is king. Cash gives you optionality. It lets you meet obligations without being forced to sell assets at the worst possible time. It lets you buy assets from forced sellers at distressed prices. It lets you survive while others are panicking. I'm not saying hold 100% cash, but I am saying that having 6 to 12 months of living expenses in cash or cash equivalents is prudent, and if you're heavily invested in risk assets, consider raising some cash by trimming positions that have run up. Third principle is that hard assets with no counterparty risk become extremely valuable in a system-wide crisis. In 2008, gold performed well, rising through the crisis and continuing higher as central banks printed money. Physical gold and silver don't have counterparty risk. They're not someone else's liability. A bank can fail, a government can default, a company can go bankrupt, but an ounce of gold is still an ounce of gold. I'm not saying go all in on precious metals, but having an allocation, 10 to 20% of liquid net worth, gives you a hedge against currency debasement and system instability. And I do mean physical metal that you control, not paper gold ETFs that might face redemption issues in a crisis. Fourth principle is that you need to stress test your own balance sheet. Look at your debts. Do you have variable rate debt that will get more expensive if rates stay high? Do you have debt maturing soon that needs to be refinanced? Can you pay it down now while you have cash flow? Look at your assets. Are they concentrated in a single asset class, like stocks or real estate? Are they liquid? Can you sell them quickly if needed? Or are they illiquid and you're stuck? Look at your income. Is it stable and secure, or is it at risk if there's a recession? If you're employed, how recession-proof is your industry? If you're a business owner, how would a credit crunch or demand shock affect your business? Identify your vulnerabilities and fix what you can. Fifth principle is geographic and institutional diversification. Don't have all your wealth in one country's banking system or one country's currency. If you have significant wealth, consider holding some assets offshore in jurisdictions with strong rule of law and stable banking systems. Don't have all your money in one bank. The FDIC insures deposits up to $250,000 per depositor per institution. If you have more than that, spread it across multiple banks, or use a service that distributes your deposits across multiple institutions to maximize FDIC coverage. Don't assume that your brokerage account or retirement account is completely safe. In a systemic crisis, there can be issues with access, with clearing, with the solvency of the institutions holding your assets. Having multiple relationships and multiple custodians reduces concentration risk. Now let me give you specific tactical steps based on your situation. If you're heavily invested in stocks with significant gains, consider trimming some positions and raising cash. You don't have to sell everything, but if you're 80 or 90% stocks, and you've had a good run, taking some profits and moving to 20 or 30% cash gives you a cushion. If there's a crash, you have dry powder to buy at lower prices. If there's no crash, you still have 70% invested to capture upside. If you're holding long-term bonds, understand that you're exposed to interest rate risk and credit risk. If rates rise further, your bonds lose value. If there's a credit crisis, corporate bonds could get crushed. Consider shortening duration or moving to very short-term treasuries that are less interest rate sensitive. If you own real estate as an investment, especially commercial real estate, look hard at your debt situation. Can you refinance now at a fixed rate to lock in certainty? Can you pay down debt to reduce your leverage? Can you sell properties that are going to face stress and redeploy into more stable assets? If you're a renter and you're considering buying, be very careful about timing. Real estate prices could come down significantly if mortgage rates stay high and the economy weakens. Don't feel pressured to buy into a falling market. If you're thinking about major purchases or investments that require financing, get your financing locked in now. If you need a mortgage, lock your rate. If you need a business loan, secure it before credit conditions tighten. Once a crisis hits, credit availability disappears and rates spike. If you have a 401k or IRA, review your allocation. Many people are in target date funds or balanced funds that are heavily weighted to stocks and bonds. Consider whether that allocation makes sense given the risk environment. You might shift more towards stable value funds or money market options within your retirement account to reduce volatility exposure. If you're close to retirement, this is especially important because you don't have time to recover from a major drawdown. And look at your emergency fund. Do you have one? Is it adequate? In a crisis with potential job loss and market chaos, having liquid reserves you can access immediately is critical. This should be in a high-yield savings account or money market fund, not invested in stocks or locked up in CDs. For those of you who are more sophisticated and have larger portfolios, consider strategies like buying put options on broad market indices to hedge your stock exposure. It's like buying insurance. You pay a premium for the puts, and if the market crashes, the puts pay off and offset your losses on the stocks. Or consider allocating to strategies that do well in volatility and stress, like managed futures or long volatility funds. These are not appropriate for everyone, but for people with the knowledge and capital, they're tools to reduce portfolio risk. And finally, invest in yourself and your skills. In a crisis, human capital is the most important asset. If you lose your job, can you find another one quickly? Do you have skills that are in demand? Are you networked? Are you valuable enough that you'd be retained in a downturn? If not, spend time now building skills, building relationships, building your value. and think about alternative income streams. If you lose your primary job, do you have a side business or freelance work or rental income that can keep you afloat? Diversification of income is just as important as diversification of assets. Here's what I'm doing personally, and this is not financial advice, just transparency about my own approach. I've reduced my equity exposure from about 70% of liquid net worth to about 50% over the last year. I've raised cash to about 25%, which is higher than I'd normally hold, but I want dry powder if there's a crisis. I've increased my precious metals allocation to about 15%, split between physical gold and silver that I control. I've paid off all variable rate debt, and I have no debt maturing in the next few years, so I'm not exposed to refinancing risk. I've stress tested my expenses, and I know I can cut my burn rate by 50% if needed without affecting quality of life significantly. I have emergency cash reserves that could cover 12 months of expenses at my current burn rate or 24 months at reduced burn, and I'm watching the data daily. I'm watching bank deposit flows, commercial real estate transaction volumes, European bond spreads, Japanese yen movements, and credit default swap levels. These are real-time indicators of stress, and if they start spiking, that's a signal to get more defensive. The key insight I want to leave you with is this. We are living through a period of extraordinary financial fragility that most people don't recognize because we haven't had the crisis moment yet. Everything looks fine on the surface. Stocks are near highs, unemployment is low, the economy is growing, but underneath, the stresses are building. $15 trillion or more in at-risk positions, central banks out of ammunition, governments out of fiscal space, and no plan for what happens when something breaks. This is not fear-mongering. This is risk assessment based on the data. And the appropriate response is not panic, it's preparation. You position yourself so that if the crisis comes, you're resilient. You have liquidity, you have hard assets, you have diversification, you have skills, you're not over-leveraged, you're not concentrated in vulnerable positions. If I'm wrong and the crisis doesn't materialize, what have you lost? You held some cash that didn't earn much return. You bought some gold that might have underperformed stocks, but you still participated in the upside with your remaining equity exposure. And you sleep better at night. But if I'm right and the crisis does come, being positioned correctly could be the difference between weathering the storm and financial devastation. The people who were prepared in 2008, who had cash and didn't panic, they came out ahead. They bought assets at distressed prices and made fortunes. The people who were over-leveraged, who were fully invested with no reserves, they got wiped out. Don't be the person who looks back in 2 years and says, I saw the warning signs, but I didn't act. Position yourself now while you still can. If you found this valuable, drop a comment below with your biggest concern about the financial system right now. Is it the banking sector, commercial real estate, sovereign debt, inflation? I want to know what's keeping you up at night. And if you have questions about how to implement any of these strategies, drop those in the comments and I'll try to address as many as I can. The community here is smart. We're all trying to navigate the same challenging environment, and the more we share information and perspectives, the better prepared we all are. Subscribe if you haven't, because I'm tracking this situation daily, and I'll be putting out updates as the data develops. Tomorrow, I'm breaking down the commercial real estate crisis specifically, the timeline of debt maturities, which markets are most at risk, and what it means for regional banks. Stay sharp, stay prepared, and remember, the goal isn't to predict the future perfectly, it's to be resilient across a range of possible futures. Talk soon.